Investors usually face a strict binary choice: hold reliable, cash-generating legacy fossil fuel producers, or buy into high-growth, cash-burning green technology disruptors. TotalEnergies is attempting to run both systems at once. They are engineering a hybrid model, utilizing the vast physical footprint of a legacy oil and gas major to power a rapid pivot into the future of the grid. This chart highlights the raw scale of their current operations. In the first quarter of 2026 alone, the company recorded $54.1 billion in sales. Their exploration and production activities actively span more than 50 countries. They are executing this pivot while navigating a fractured global supply chain and active regional conflicts that have forced sudden production shutdowns across the Middle East. TotalEnergies is attempting to self-finance a massive energy transition entirely from within its own balance sheet, using the cash flow of today to pay for the infrastructure of tomorrow. Management describes this internal mechanism as the two pillars strategy. It operates as a closed-loop financial recycling engine, taking the capital generated by one side of the business and injecting it directly into the growth of the other. Pillar 1 is the cash pump. This heavily relies on the immense physical scale of their legacy upstream and integrated LNG businesses. By leveraging a deep portfolio with a natural decline rate of roughly 3% per year, management targets a highly disciplined 3% accretive production growth in oil and gas. Pillar 2 is the high-tech grid, the integrated power segment encompassing generation, storage, and trading. Here, the company targets aggressive expansion, projecting a 25% growth rate in electricity net production for 2026, aiming for roughly 60 terawatt-hours. Deploying its own capital rapidly enables a faster time to market on power projects, capturing a 10% premium on power purchase agreements. This internal funding lowers the cost of supply, entirely bypassing the high interest rates pure-play renewable startups face in external capital markets. The company insulates its green growth from volatile external credit markets, expanding their power infrastructure without diluting shareholder value or taking on punishing debt. Strategic theory only holds up if the balance sheet supports it. We have to look at the first quarter 2026 earnings to see if this operation actually fits the criteria for growth at a reasonable price. Adjusted net operating income surged 36% quarter over quarter, climbing to $6.3 billion in Q1 of 2026. This income is backed by highly liquid capital, generating $3.3 billion in operating cash flow and a massive $8.5 billion in cash flow from operations. Total revenue only tells half the story. To test a company's capital discipline and efficiency, we have to examine their return on average capital employed. The official consolidated accounts report a 12.7% ROACE. This confirms they are keeping operational expenses per barrel strictly contained, even as they aggressively deploy capital into new power ventures. These specific financial metrics separate the company from a stagnant legacy oil stock. They possess the cash generation of a traditional producer, while hitting the efficiency numbers of a textbook GARC asset. Even a highly efficient business model faces external pressures. CEO Patrick Pouyanné is currently navigating immediate macroeconomic storm clouds, threatening the remainder of 2026. The portfolio has taken specific hits due to regional conflicts. They face recognized production losses in Iraq, Qatar, and offshore United Arab Emirates, alongside a 1.5 million ton reduction from LNG shutdowns in Qatar and Abu Dhabi. However, the balance sheet has a built-in geographic hedge. Because expected 2026 growth is largely outside the Middle East, a mere $8 per barrel increase in global Brent prices completely offsets the cash flow lost from impacted Middle Eastern assets. They are actively future-proofing the integrated power segment, leveraging a new global competence center in India to inject AI directly into their global grid operations. Management's effectiveness here isn't based on predicting or avoiding geopolitical chaos. It is built on engineering a global footprint that mathematically neutralizes it. The bull case for TotalEnergies is straightforward. It operates as a highly profitable legacy hedge, combined with a rapid 25% power growth engine, all while sustaining a nearly 13% return on capital. The bear case sees a company walking a very thin line. They remain heavily exposed to volatile Middle Eastern conflicts, while executing a complex, highly capital-intensive pivot into renewables and tech. So, is this dual-pillar engine the ultimate transitional energy fortress? Or are they attempting to serve two entirely different masters in an increasingly unpredictable world? Let us know how you are weighing these risks. Vote down in the comments and subscribe to Stock Simplified for more cinematic breakdowns of the market's most complex assets. This video is strictly for educational purposes and does not constitute financial advice.